everybody. Welcome back to the Real Perspectives podcast. I am one of your co-hosts, Vladimir Bosanas, the co-founder and publisher of the Registry. I'm joined today by my co-host, Rob Zirkle, Director of Development at Prince Street. And we have a special guest today, Chris Freise, Principal at Redco here in the Bay Area. Gentlemen, welcome.
Hey, everybody. How we doing?
Doing good, good.
Yeah, thanks for having me, guys.
Excellent.
Glad to be chatting
I'm
with you
excited about
guys.
this one.
Yeah.
Chris, I think it's probably worthwhile asking you to give us a little bit of an overview of, Redco, who you guys are, just for our audience to kind of hear a bit about, how the company was founded, what you do there, and what you guys are trying to accomplish.
Yeah, happy to do that. So we're based in San Francisco, two brothers, founding partners. We started about 8 years ago. Um, we play in the three West Coast main metros, so the Bay Area, Seattle, and Southern California. Most years of the cycle, we're doing industrial and a lot of industrial. That's probably 7 out of our 10 deals a year, and that's a lot of it's kind of morphed into advanced manufacturing now that that's playing in that space. um Through coming out of the last recession, we've been buying an opportunistic buyer of San Francisco office. It's our only office properties we own six in the city, and we've been buying them over the last 3 years. And then we started kind of a third business line, which is ground up multifamily. We have two entitled projects in the Bay Area, and we're working on a few others. But that's kind of background on the types of products. And over our company history, we've invested about $1 billion in gross transactions, and we currently have 25 active projects across our portfolio. Some are exceptionally stabilized and doing great, and some are still chunking through some of the problems from yesterday. So we're just, that's a little bit about us. Anecdotally, our company was, Redco stands for Robert Edward Daniels Company, and so that was our grandfather. And
Nice.
yeah, he started the firm back in the 50s. He was a bricklayer, came up through the mason trades, and started various subcontracting businesses, and then started doing real estate development. His last project was in the late 80s. He built a hotel that my uncle was the project manager at, and my mom was the hotel manager, and he sold it and retired, played golf, and savings and loan crisis happened, which is, a lot like today's office market.
Yeah.
And the company sort of ceased to exist. So it was always my brother and I, it was always kind of our goal to start it up, and that's kind of the genesis of the name a little bit.
Oh, that's really neat. That's a nice backstory. Yeah.
Yeah.
So, Chris, you explained in your intro you have this unique perspective. Not terribly unique, but it's unique in a sense that you play up and down the coast, and you really get to see kind of how each of these markets are performing, especially in the last 12 months or so. I think we've said on this podcast many times, Northern California has gone through really an exceptional sort of recovery over the last year. But tell us from your point of view. I mean, you're an operator, you're an investor, you're also a developer. Was it as remarkable from your perspective, and how did it flow across this region, and do you see it sort of flowing across northern the Pacific Northwest and also Southern California as well?
So you're asking specifically, Vlad, just about the industrial space and kind of that
Well, you're
particular.
also involved in some office, right? So I'm just kind of
Yeah.
curious from like an investor developer point of view, not just industrial, not just one specific product, but just in general, was the last 12 months, do you look back and you're scratching your head, you're like, wow, that was incredible, or did you see some things already coming and it's sort of playing itself out, the way you probably thought it would?
think the answer is probably there's a little truth to both sides of what you're saying for the office market. So in the office market, we we sort of had this thesis that the reason that there was so much distress in the market, which was true, which is everybody had to buy properties all cash. So that really changed how they were valued. And particularly when you thought you could never lease it. And I thought the never leasing part of it was short sighted. I thought that that was a moment in time. I thought office would eventually come back to some more normalcy to it. Um, but so our thesis was to try to buy office properties with debt, and we figured out a way of doing that on all of our assets that we purchased. So it was, and it's obviously a lot different now. You can get a loan on pretty much every office property you're trying to purchase in San Francisco, but 3 years ago you couldn't. So that intrinsic felt like an arbitrage in the market in the office space. The leasing side, I'll tell you, we were wrong. I thought it was going to take years, more longer than where we sit today. And the AI recovery has been exceptional, and we've been the beneficiaries of that. Pretty much all of our buildings, except for our last purchase, which is the Wells Fargo building on California Street, are 100% full. We're in
And
leases at
how
300.
large is the Wells Fargo building? Just as a reference.
Yeah, it's 400,000 feet, 12 stories. We purchased it from Wells Fargo in November of last year, and they're just in the process of moving out of the bank. The branch closed this month, and then they're still occupy a couple floors upstairs, so they'll be moving out of those. And we're out elephant hunting for users in the 200 to 400,000 feet range, and that um, is an exciting space to be in. All of a sudden, it wasn't 9 months ago or even
Right.
12 months ago,
Yeah.
but the market has really moved to the larger blocks where 3 years ago the recovery was smaller size tenants.
Hey, Chris, along those lines, from that perspective, when you're out and your brokerage teams are out elephant hunting, like to be able to say out loud after the last few years that you're hunting for 2 to 400,000 foot users feels super good. I understand that. What's your guess about tenants in the market? Like, how deep is that $200,000 to $400,000 block? You got to feel pretty bullish that there's one out there to buy that.
Yeah, I think we do. I think we're pretty excited about what we own. My take is that there's if you talk to CB or Alexander Quinn down at JLL, they some of the best in research on both sides. They'll tell you there's 40 tenants for 100,000 feet or more, maybe 50. Now, what's unique is that what those tenants want and what those blocks of space are out there are not quite converging just yet. The musical chairs continues where tenants think they have more leverage in a market that they're slowly losing it. And
And is it based on pricing? Is it based on what the property has, amenities? They want Class A plus. What is it that you think on the tenant side that they're really longing for?
I mean, location really matters. So you got to be a central location near transit, in kind of a recovering area. So like Yerba Buena has felt like there's quite few large blocks down there, and tenants really struggle with kind of being next to it. But the value in terms of pricing is there for those tenants there. Um, I feel like if you're the big differentiator is the size of your floor plate. And so all the great buildings with big floor plates went quick. And we fortunately with the Wells Fargo building are a 28,000 foot floor plate. Most of San Francisco's 15 to 18,000 feet. So just think about your average 100,000 foot tenant. Would you rather be on 4 floors or 10? Right. Right. And so I think that, I just think that is from a what these companies are trying to build in terms of culture and product and cohesion. It's really hard to do when you're that segmented across several floors. And so you slice up the big blocks of space by location and size of floor plate alone. And you take down the number of options that are out there from them from, let's call it maybe 20 or 30 to 8, 9, right? So that kind of supply demand where these tenants are finally figuring some of that out, but it's just they had to go kick tires on a lot of it. Now there's plenty of space to lease. It just, in my perspective, is there's just not that much good stuff left.
How do you think that that drives office culture, and particularly AI is such a strong driver in the leasing market right now? How do you see? I mean, you've got AI tenants in your buildings. Like, how do you see them using their space differently to build culture inside an AI organization that's remarkable from the past cycle?
It's a great question, Rob. It's not that different than tech companies from prior sort of cycles that we've seen. It's offering food, great food services. It's offering great space to work in. It's trying to build a culture where people are invited and like coming to work. And it's a lot of those things that, the hospitality side of office continues to be very robust. But um those are all tried and true things. Our company down at 28 Utah, a bridge is, you know, um has an amazing food service that's offered by one of my good friends. And we found a lot of success with just food being a way to build culture. And, food has always been kind of a given. Like catering comes in on platters and it's served and it's sort of given. This is much different. This is an elevated experience. It feels like you're sitting down to a healthy meal, a great meal, and you're building like a relationship with your coworkers. And it's hard to describe without seeing it, but it's just like it's got a long communal table, just invites people to come and eat. And I think a lot of culture is built around the fringe of what you do in the space. And it's so that's my take. I don't think it's drastically different than what we've seen in prior cycles. The new hot things are wellness. So, saunas and cold plunges and some of that stuff you're seeing go in. But I still think the most tried and true is food. People really bond around food. So
Interesting. Yeah. And speaking of which, Chris, the central business districts during COVID really suffered, and San Francisco was certainly kind of a poster child, I think, of things going kind of badly, right? Have you seen the recovery around this specific property and kind of around that, CBD area? I know there's been a lot of restaurants that have gone under and have closed, but there is a general sense of activity back in the city, right? What's your sense?
yeah, I, I think that like so most of our properties are in two areas. We're in North Financial District, so clustered around California Street. Um, and then Showplace Square area, so the kind of the middle between Mission Bay and the Mission. Um, I've as it relates to downtown, we were really nervous about leasing the retail up, and now that story has completely inverted. You got some great retailers coming in and filling great spaces. So like in our 300 California Street, we've got Antitown Coffee opening up, which opens up in November. This is I believe, their 10th store, but it's one of their most ambitious ones, and they picked it for California because they think it has the opportunity to really be something special. So they've got a guy spinning vinyl, and they're going to potentially offer after hours coffee flavored cocktails. So it's just where I think people kind of are used to the headlines from before. I think that there's a lot of retailers that are taking advantage. Um, and the empty spaces are not really there anymore. So
Yeah. What about Seattle? What about Southern California? What's your kind of perspective on those two markets in terms of general recovery?
yeah, um, I mean politics matter. I hate to say it, they always do, but local politics um, kind of read the investment climate. Seattle has had some steps back in local politics from an investor viewpoint. Like I had a institutional investor that we do some work with, looking at San Francisco and Seattle and saying not quite yet Seattle, where Seattle to us looks a little like San Francisco 3 years ago. kind of interesting. It's feels like it's recovering, and it feels like there's opportunity. But you kind of need some of that goodwill optimism that Mayor Lori's sort of bred and cultivated here, and um, up there, it's not. It seems to be kind of moving the opposite direction, and so Bellevue and the other side of it has been very robust. But I just, like Anthropic's big office lease up in Seattle is a good start. It's a great start. To me, it's the first real AI company of scale in the Seattle metro. Now, there's been plenty in Bellevue, but it's actually planting a flag saying we're here. We want to kind of build here, and that's a good sign. I think that should be encouraging for investors. But I mean, uh, you can still buy buildings for around $100 a foot in Seattle with, fairly great assets and well located, and they should lease at some point. Our perspective, and I think it's a common investor perspective, is that Seattle trails by 12 to 18 to 24 months both ways on a recession and the recovery. We've kind of seen that as we've looked at um, both markets. But it does feel like Seattle's turning a corner. Like, it's not all doom and gloom up there when you talk to leasing office brokers. They're starting to smile again.
And
So
it's not just the summer and the sunshine, right?
that's true. It's not just, I mean, they got some, like, they won the Super Bowl, right? The Mariners are doing all right. And you just think sometimes you need a little bit of, sports team goodwill, political goodwill, to kind of change. And I really do believe that optimism is several small steps. Everyone's looking for a big catalyst, but you kind of have to see it like a momentum. It's usually several small things that lead to bigger things. So
Hey, Chris, on those lines in Seattle, just given the fact that you've got some multifamily properties that you've got entitlements on and are trying to put together here in the Bay Area, are you looking at Seattle for housing at all?
we're not, and I don't know if that's intentional, Rob. I think a little bit of it is, Seattle built a lot of housing. So, like, we're reading a ton of headlines. Like, let's just say, like, there was a few headlines this week about the Marina Safeway, right? It's the front page of the journals and the Standard, different publications, and there's a big push and pull of housing in California. Seattle just doesn't have the same governors on housing. To their credit, they're like build. We want to encourage building housing, and
Yeah.
like, to the point where they absolved one of the first cities to get rid of their single family home designation across the whole city. So I think that they've removed more of the barriers, and the tenants and the residents of that city have benefited. Rents are down. There's a lot of high rise construction that was built, and it's still trying to lease. And so it's just um, more supply, and like a probably less interesting market to even start to think about building. And the Bay Area still has its challenges. We're not seeing a ton of housing getting started here, but we're starting to see some. I do see some green shoots on that side. So I think for us, Seattle will be a long time for housing, but we're going to try to do more here in the Bay Area and Southern California.
Imagine that you increase supply and pricing goes down. What a novel concept.
You hear a lot of, like, here's a common argument that I hear that I think falls on deaf ears, which is, new housing is not affordable housing. It's really easy to point at a new project and go, well, this isn't affordable for the people that we need to live here. And that's right. Newest product, best product should command the highest price. But the people moving out of the next closest price product moved up to the higher price, and that freed up housing down the chain. So, like, your C, D, E, F type buildings are now empty and cheaper. And so it kind of that whole ecosystem. And there's a lot of people who stand by the, like, new housing isn't for everybody. And I think Seattle's your one really shining example of it is. You build a lot of supply, housing gets cheaper across the board.
Yep. Yep.
So,
Well, with respect to the Bay Area, I mean, there's definitely been some positive growth in rents in multifamily. Obviously, the AI leasing boom is just, kind of another, catalyst for confidence and just positive energy. How do you think that's going to translate? I mean, you've got some projects entitled in and around the Bay Area. How do you think that translate? What are those like fiscal levers that need to get pulled to actually start on some new construction for housing? Some definite entitlement activity, but how many housing starts are there on the horizon? I think kind of remains to be seen, right? What do you think needs to change to unlock that?
I think over the last 6 months, we're starting to see some real robust investment in type 3 construction. So the first one I saw come out of the ground was the fish market site that Acclaim's doing in Palo Alto. It's approximately 400 units. Stanford's an investor in it. Invesco came into it. Um, and the depth of interest in capitalizing that project was really deep.
Yeah,
There was
we
a
should
lot of
also
people that,
mention 400 units for a town like Palo Alto is a very big number. This is not a typical kind of construction for this Silicon Valley town, correct?
yeah, that's right. I mean, like, that's exactly right, Vlad. Like, I think over the last 25 years, there's this abysmal like stat of like less than 250 housing starts in that city, right? So it's got one of the worst supply demand equations with a very strong job market. Like, the research park, I mean, is a classic example that was quoted. Between 2000 and 2025, there was, the number of jobs in the city of Palo Alto increased from 60,000 to 100,000, but the number of housing units was sub 1,000. Like, it was somewhere around what I just quoted you, the 250 to 500. And that's a problem. And I think that is why you're seeing Sacramento come out with all these sort of ways to loosen up housing, and you're seeing stuff start. So I think the better markets will see construction starts, and I'm starting to see them kind of throughout Silicon Valley. And I think San Francisco, the better located sites are going to, that are kind of in that type 3 construction, are definitely going to go. The high rise residential construction is still a challenge just from a cost perspective. Just trying to solve for that return on cost that everybody can stomach for a development deal today is hard.
Tough, yeah, yeah.
Yeah, yeah.
Let's also touch base a little bit about Southern California. So, are you going into this market on the industrial side? What do you like there, or does Southern California also, give you an opportunity to sort of do, commercial and multifamily at some point as well?
We're chasing opportunities. So, like, we're looking at distressed office down there. We're looking at land. So from my perspective, the most distressed asset classes coming out of this, you know, last little interest rate recession blip, COVID blip, were those two asset classes, land and office product. Now, the Inland Empire might be the one unique third bucket along the West Coast where there was so much industrial product built, and it's, to me, the barriers to entry to that market have been something that we've been trying to crack for our whole 8 years of being in that, in business. It's very challenging. It's very aggressive. Leading up to interest rate corrections, it was a sub four cap market, and that's changed. It's widened out, and a lot of it has to do with port related traffic, and just how, I think the three West Coast ports really were decimated. And we're starting to see that come back. The Bay Area trap, like that, the container stuff feels stronger here. Port of Tacoma's starting to find its sea legs, and the same is true of LA and Long Beach. So that should all mean good things for Inland Empire stats and things to come, but there's still kind of, that would be the third prong, I think, in terms of real distressed value opportunities. It's just new construction, industrial product in kind of Southern California. So we see a lot of value down there. We're offering on land right now. That's where I would say that most of our LOIs are going out on land. We're starting to look at some of the office product on the west side of LA and Orange County and North San Diego, but we have yet to kind of find anything that sort of feels compelling relative to some of the opportunities on the office side we're seeing in San Francisco and Seattle. I just think that the demand drivers in those pockets, while strong, just aren't as strong from an office standpoint as we are here. It just feels like we're LA, like downtown LA has never been a strong office market. It's like, abysmally optimistic in terms of how often that thing feels like it's going to get going. So, and I do feel like the AI impacts to some of the drivers in Southern California on the office side, cinema, Hollywood, that stuff's real. Like there's a lot of movie studios that are super distressed, and you're
Yes.
sitting there looking at that space, and you're going, man, this is great real estate. You're sitting on 25 acres of warehouse product in a really infill location, and they can't
Yeah.
lease it.
Yeah.
What happens next with some of that space is kind of interesting. But
Yeah.
um, so yeah, but we primarily industrial keeps our focus in Southern California. It does feel like a great space for us to be in. So,
As you look at kind of as we get into the second half of 2026 here, um, do you see anywhere in any of these three markets an office product breaking ground?
oh, probably I'm gonna eat crow. I mean, it's really um, the reason I say that is, there's some stuff happening in San Francisco proper where it kind of feels like there's no um I mean, we're all the headline grabbers are always the high rise towers. You're talking about Hines on the PG&E site. You talk about um, Oceanwide with BXP and Dan Kingsley and team. Talk about the related tower. So those ones always get you the biggest headlines. I feel like one of those will land a, a tenant. We've been talking about the related one forever. I feel like those guys will land somebody and eventually get out of the ground. The challenge with those towers is the Prop M allocation and some of the noise around, do you keep your office entitlements? And you kind of, these guys have, timing a high rise tower is really hard to figure out in San Francisco. And then you kind of couple that with, oh no, I may lose my entitlements if I don't. It's going to create an interesting dynamic of go, no go for a lot of these guys. So I think we will see some of it go. Where I think we might be surprised is some of the smaller kind of PDR, low rise type of stuff that actually might happen sooner. Whether you're the power station, some of the entitled projects in the Mission, Showplace Square area where you can almost purpose built a little campus for some robotics firm or I could see something like that also taking place. So you might put that in your office category of a start, but it's locationally driven, like gotta be in this location. And I also think it's product type driven. It can't go in a high rise. So
Is power, you mentioned power as for one of the robotics firms potentially. How big of an issue is power these days? I mean, obviously with AI and kind of data centers, that seems to be on the forefront of the news cycle. But in terms of office development, is that a challenge as well?
yeah, I mean, it used to be where Santa Clara Power or this like operating within Silicon Valley Power operating within the city of Santa Clara used to be a huge win. And I've over the last 3 years, we've seen data center owners with data center entitled sites flip them to industrial. So like De La Cruz just closed, Tishman just bought it, and it's like a 24-acre site, and that
This
will
is in
go
Silicon
to
Valley, right?
yeah, sorry, Santa Clara. So Santa Clara, Silicon Valley, and it was going to be very expensive data center, and because they couldn't get to the power needs needed for that for for a really long time, they threw up their hands and flipped it to an industrial developer to build
Yeah.
advanced manufacturing. So yeah, it's everything. I also, powers. It's funny. Um, while every tenant says they need, you know, whatever they're throwing out. Like if you're a robotics company, I need 5,000 amps. When you kind of look at what they're actually doing in the space and you test it, like a lot of times we're finding that they don't actually need as much power as they think they do. So I think that it's on the power side. It, it, like we have a brand new building in Hayward, California, that we built with New York Life. It's 100,000 feet and it's got 4,000 amps of power plus a solar array, which gets you up to about 5,500 amps total. And we got tenants coming in that are all advanced manufacturing groups, and it's a different looking tilt project. We're really excited about it. It fits kind of a creative class tenant, and to me, everybody comes in and goes, "Man, this is awesome. I need all this power." And then if they're doing a test fit and they lay it out, like they kind of typically maybe need like half. So I think it's an interesting dynamic where if you have it, it checks boxes and you get tours. Is it absolutely necessary? I think we'll find out. I think
Well, and
some
the
of these
crazy
guys
thing
are.
about that too is like the power that utility companies, and particularly PG&E, exert over this stuff. So if you entitle something with 4 to 5,000 amps and tenants using two, like you're either on the hook as an owner on a power purchase agreement set up where you're guaranteeing that you're going to pay for that draw, and if you don't, then PG&E will take it and redistribute. You might be left with a different situation down the road as a building owner. It's like power is a huge benefit and risk factor, actually. So, as tenants, particularly in the advanced manufacturing space, but anybody in the AI sphere that wants to onboard, any kind of even small server farm for their R&D purposes and stuff, it's like it presents real challenges, and the surcharge on the grid and how PG&E and other utility companies manage that is like really an exercise in patience and strategy on the developer side to be able to create an outcome that's a win for everybody.
I mean, yeah, that's absolutely right, Rob. And you know who pays for it ultimately in these buildings is the tenants. The surcharge that PG&E and the penalty comes through as a net operating expense.
Yeah.
It's right to the tenant, and they're the one driving that they need it. Yet a lot of times we're finding that they don't. But I'll give you an anecdotal story that I think this is a tenant I met with last week. It's a robotics company. They're in 10,000 square feet. Their business line has robotics for data center implementation in terms of basically using robots to rack and figure out how to figure out a rack. And typically to date, racking had meant that humans were doing it. And this is a robot that does it, takes twice as long, but removes all the errors that typically are associated with a human installation. And if you've ever seen somebody rack, they're installing like 1,500 little cords into a single rack, and they all come with barcodes. And one of these being off is a big problem, and also just kind of the hygiene relative to the installation. So there's like a company, it's in 10,000 square feet. They're out in the market for 100,000 feet. And this is a classic example. And the 25-year-old founder goes, "Yeah, I got 500 robots showing up in a month. What do you have?" And and you're sitting there, and this is a tenant who's he lives in San Francisco, and he likes being in the Mission and Mission Bay, Potrero area, like where the AI and robotics companies have clustered. And um there's nowhere for him to go. So where does he end up going? And he's going to end up going where we see these companies traditionally go. It's down the peninsula in the South San Francisco, all the way down in the valley,
Right. Right.
the East Bay, like American Steel. I heard just landed a big lease with um, Project Prometheus, which is the Bezos robotics company. So it's just, we're seeing these companies run out of options. There's not as much like you would think that they'd have a ton of programming and planning that goes into what they're ultimately going to need. But it's like if you're ready and you've checked the boxes on the power and the size, you're going to get a lot of looks.
Yeah, power, it turns out, is real currency. That's almost more important than anything else right now for some of these companies. It's a fascinating time.
I mean, the other side of this is JLL is selling a substation for PG&E right now. So over off of Ninth and Soma, you know, the Eric Hansen and the JLL team are marketing for sale a 12 megawatt warehouse, 3 stories, 20,000 square feet. So the question, there's value there. What do you do with 12 megawatts and 20,000 square feet? If you racked it, you still couldn't use it. So it's not, it's like and that there's demand for it. It's just like, what is that worth, and how do you try to underwrite something like that? It's a really fascinating kind of opposite case of like there's too much power and not enough building.
Right.
So like, what so I think we're finding that most of the Bay Area is too much space and not enough power for these tenants in terms of their screening. But the opposite can be true too.
Yeah. Yeah. Yeah.
Uh,
Chris, let's shift gears a little bit and talk about investment and money. You're obviously in the world where you're talking to a lot of investors. I'm curious, from your perspective, where does the money want to go on the West Coast? And maybe can you give us sort of a little bit of a perspective, how they view office, how they view industrial, how they view retail, hospitality, multifamily, right? Just kind of a sense, what are they chasing, right?
we're seeing a lot of interest in the two main food groups, which I think were predicted years ago, which is industrial and multi. And the amount of interest in existing industrial and multi is eh, robust. I mean, beyond robust. And I think the other side of it is we're seeing the advanced manufacturing side of that for our markets on the West Coast markets is getting lumped into that industrial category of investability. So we're
But this is
finding.
not development. This is for existing product, right? Or is it for both?
I think we're starting to kind of it's for existing product, like um the kind of aggregators of multi product in San Francisco, whether you're Veritas or Ballas Investments, or there's a handful of these guys have been around. That institutional interest is off the charts. Everybody wants a piece of that. Um, Ground up development starting to get there. I heard, we talked about why things don't pencil. It's purely a function of what an investor will stomach on a return on cost. So if you could buy a brand newly constructed product, and there's one out in the market through JLL in kind of Mission Bay to Mission area. I won't kind of out, but they're taking bids on it, and it looks like it's going to trade sub 4 cap on in place. So you start to think about that, and you go, okay, well, now what spread do I need to justify a development deal? And your parameters will change, where most people were starting a year ago at a 7. Currently I've been hearing a lot of like, I need a 6 to a 6.25 on a return on cost to do a development deal. And I think that stuff like that will change people's perspective on, no, I can do a 5.5, or I can do a 5, and we're going to see more starts. So we're seeing investors want all those things, and they're sort of reacting to way existing products pricing and then recalibrating new development. On the industrial side, I mean, anecdotally, Rob's firm, Prince Street, and ours were tracking a building on Kiefer. And, I think this is a kind of testament to how like the hockey stick of pricing we do feel today, is that for the right product and the right location, you know, we sat around, had lunch, decided that we felt good here at this price. Let's call it in the high, mid to high 20 million range. And, um, that we thought that there'd be a housing developer that would blow us out of the water potentially. It's going to an investor, and the investor surprised me at like mid 30 millions. And the answer why is like because they want advanced manufacturing space in the Bay Area. And so that surprised us. And I think, we thought that that would be owner user pricing and or housing development pricing. And it was an institutional investor. S- So you're sitting there and you're like, okay, well, why'd that happen? And it's like, because there's just not enough of this stuff. They're
Right.
all these guys are getting back to work. They want to be in those two food groups. And then eventually that will trickle into the development pipeline for both. And I think that the same is true on industrial land. We just bought 13 acres down in Sunnyvale. We're excited about from UPS to build a 270,000 square foot advanced manufacturing building. And, um, we're seeing land go up 20-25% across the board on industrial
Wow.
land. Yeah. And that's when you had like capitalizing just old yesterday's land price was hard. And we're seeing, there was, a a great site in Fremont, well located, tied up at like 70, low 70s per land foot. Um, and I think if you took it out today, it'd be $85.
Yeah.
So it's just, that's, and then what you're like, so what's changed? The construction costs haven't gotten any cheaper. Rents are up. Rents are definitely up, and investor interest on the rents and demand side are up. But I think honestly, it's the institutional capital solving for a lower return. It's not so much like because the cost side sometimes tend to step up in parallel with rents. Contractors are good at doing that. Where
Yeah.
they see people making more money and they go, okay, time to raise pricing a little bit. So I think that's you're seeing the institutional money come back in those both food groups for existing product and ground up.
Yeah, interesting. How are they perceiving, Southern California, Northern California, Pacific Northwest, as you compare those markets to, let's say, I don't know, the market in Texas, the market in Chicago, the market on the East Coast, are any of the, three West Coast markets kind of in the top five, top three?
From I think that they so from a multi side, I think that people are nervous and excited at the same time. I think that they're nervous about some of um the inclusionary sort of reactionary to like, hey, these are my property rights. No, they're communal kind of thing that you're seeing kind of play out across the US. Like similar to New York. But I think that the demand side is just too strong from the tenant rent and just the supply demand that we're seeing, on the multi side. We're still the West Coast markets are where folks want to be, where the job growth demand demographics look really good. And that tends to also be true for industrial and advanced manufacturing space. Um, you asked a question like, how do they compare to Seattle and Southern California? Capitalizing a deal for ground up is almost impossible in Seattle right now. Seattle Metro. I mean, it's not impossible, but you're seeing developers contribute dirt at bases lower than what they paid for before to get something going. Um, and same is kind of true in the multi space. Um, Southern California feels a little closer to us here in the Bay Area. It just feels like for the right locations and the right product types, you're going to see housing get built, particularly in LA. LA has just got a shortfall of it, just due to all the things that have happened up there. So it just um, does feel like that's really interesting to a lot of folks. But um, I mean, Rob, you guys got a big housing project in Menlo Park, right? Your townhome project,
Condo project actually.
condo project.
Yeah.
And what are you guys doing there?
Well, it's interesting the time that frame that we're in right now. So places this particular deals in Menlo Park, which is what Chris is asking about. So this is a singular site that was the site of a small office building, former Bank Branch, Comerica. We're going to renovate and reposition the office building and then use that parking field to build some condominiums. Condominiums make the most sense from a business case standpoint. They're a little bit better than apartments, just given the location. And it's it's an interesting experience both on the investment side. This is all going to be syndicated, friends and family money, which is a great investment for vehicle for that size project. But it's forcing a great cooperation between us and the city too, because we have access to, as Chris well knows, state tools, a litany of them that help everybody just make decisions faster to get projects built. A little bit earlier in the conversation, we were talking about supply side. Up in Seattle, as an example, you just put housing out there, it'll ultimately have an accretive effect and downward pressure on rents and values, which is good for the homeowners and renters out there. So this is that, right? We get to use all these tools to our advantage to help collapse time, just to get things done, which is great. Yeah. So we're really, we see this as a real opportunity in just peninsula towns in general, where we have sites like this. It's such a car-centric culture in the South Peninsula that you can utilize these to your advantage to solve urban problems and create good investment opportunities for our clients, and also bring good design to the equation too. Which makes me want to ask Chris, just so all the listeners out there know, Chris and I have a really long-standing relationship. In my former life as running Brick, which is an architecture and design firm, we were destined to work together because bringing back Redco was all about bringing back, his grandfather's training in being a bricklayer, and my company was named Brick, so we were destined to do deals together. I gotta ask, you're one of the operators, developers out there that care deeply about placemaking and design, right? Stuff that we've worked on together has been some of the most fun I've had as an architect, but also, like you mentioned, your Hayward project, which has got to be the coolest R&D building out there. Give us some thoughts, just because we talk a lot about investment and money on these things. You know that part of the equation is just doing things that move people and inspire people to want to be where you own property. Give us your take as a developer, owner, operator about how design features into what you buy, how you move it forward, how you get it leased, how you keep people happy, how do you make a solid return for your tenants. Design is part of that.
I mean, in the case of Hayward, is a great example of it, right? So we bought incredible dirt value, what felt like incredible dirt value. It was $48 a land foot 2 years ago with New York Life, and that was a hard deal to capitalize, but we did, and we thought we were building to a 7 at the time, and we came up with what I think is a better design and a more expensive design than your most traditional merchant tilt industrial R&D builders. And it's not a lot more expensive, but it is more expensive. Um, and we think now, a year ago, that was when we were starting making the go no go decision to build it speculative, which was a harder decision back then. We thought we were building to 6, and to get to the 6, we had to value engineer some stuff out that I think we kind of miss right now, or we wish we had done. And now that the market, like we're delivering now, and where we think we're going to get rents on it, we think we're a 7.5. So like this push and pull through design of balancing investment parameters while delivering something that you think meets the market in the future is always that great challenge. Rob, you've seen it like a million times. You're one of those great, it's interesting to see you as moving over to the dark side, the development side,
Light
coming
side.
from your,
Light
yeah,
side.
sorry, light side. Okay. Moving over to the light side from the other, I guess, the dark side, but your architecture background coming in full force here. I mean, I still believe that there's better design out there that can be done cost effectively. And I think that's the balance of what this all is. And, um, you know, like Seattle, I mean, here's a funny example, but I think Seattle has better architecture than the majority of the Bay Area inventory is stock of architecture. A little bit of it was when it was built, but I don't know why that is. But the planning commissions tend to care more about the architecture to get projects through than the fees. And the Bay Area has kind of done the opposite. You know, fee loaded projects to the detriment of the architecture. So I don't know. The projects are always this balancing act of delivering the best quality that you can and trying to kind of demonstrate it. But you know, hindsight's 2020. I think we're gonna get a probably a 20-cent premium on our rent for that building, maybe 25 over our relative competition. And I think that has a lot to do with delivering a better quality building. So I just think like sometimes there are versions of this where you see, you know, you're getting paid in the return side for doing the right thing on the architecture. The devil in the details is convincing money and yourself along the way that that's how it's going to play out because no one really knows for sure. But you know, I think as you see it go, you kind of feel it a little bit more. You know, success in this spectrum like allows for better product type. But I mean, we like in the industrial space, we're calling it creative industrial. You know, and it's I think that there's a lot of merchant builders building creative class product, but you're seeing some of even the longest builders of product, you know, the Prologises and the big REITs and merchant builders all kind of pivot and try to do more of this stuff. We just think that there's more that can be done. That's my take. But
Yeah, yeah. My little anecdote about Seattle, and I used to live up there for almost a decade. I probably attended well over 100 of these design review meetings. I think the difference in Seattle about the design is that the design review meetings are actually staffed by 4 to 5 architects for each project. These are volunteer people. These are not people that work for the city or administrators, right? And so I think when you're presenting a project, you're presenting it to a group of very very discerning people, and you better bring a very cool looking project. Lest you present something bland, you will never work with these people again, right? As we close our conversation here, I want to kind of bring up a little bit of an anecdote here. Chris, this is sort of a fun one, but you, along with your other projects, own a bar in San Francisco. Tell us a little bit about this bar and sort of maybe lean into how its success or its performance has kind of been a reflection of the activity and the fun times back in the city.
yeah, come by. We pour a great Guinness, but the pub we own is called Harrington's Bar and Grill. We're down at 245 Front Street, right in the heart of the financial district, off of California Street, kind of near the Embarcadero Center buildings. But this is not a typical Redco investment. This was a passion project, but to me, it was sort of, if you what we are as a bar, it was a fourth generation original immigrant bar that opened the day after Prohibition ended in 1935. And this thing had been part of my career. It was the local real estate watering hole, and um, and for lots of us, not just myself and my brother, but like the real estate community at whole was a great place to kind of do what we're
You
doing
you you
now.
saw the opportunity firsthand.
Yeah, I guess I lived a little bit in that space, but I got sick of walking to our office past it shuttered in the middle of COVID, and I had the family no longer could operate it. They had no one left to do it, and we're going to sell the business. And ultimately, they were going to sell it to a restaurant that was going to turn it into a Mexican concept, and kind of gut it. And the family called us up, called my brother out, said, "What's it going to take for you guys to do this?" And I'll give kind of testament to the family and to us. It was like we came up with a structure, which was a lease with a purchase option, which is really unique for a family, long-term family owner. but made it work for us. And, we purchased the building in September. We've been open for 2 years. We just had our best sales month ever,
Wow.
which
Okay.
which was June, which is an unusual month for it to be the best sales month. So like I think that we're seeing like real time San Francisco recovery coming through in our daily toast sales reports we get. But just to put it in perspective, like June, we did 300,000 gross. A year prior, we probably would have done 150, and then the first year we opened, I think we did 40. So we were
Wow.
sitting there and going, there was the World Cup going, there was a lot of great things going, but I'd say most of that is just pure San Francisco recovery. And I
Yeah.
think we've appreciated, the city's sort of, and the culture of the local downtown office folks embracing our spot. We love it, and it's great that it's doing well. The other part that's kind of fun is the upstairs, which is generally like had been forgotten, is fully leased. We've got a kind of a newer Michelin star, soon to be Michelin star concept up top called Lore, doing private plated events. Anthropic's been renting out the space, and it's just great. Just there's a lot of feel good things out of it. It's a classic recovery story for San Francisco, so we're proud of it. If you guys ever, if you're come on down often, early and often, 245 front. But yeah, it's a fun thing to own, and it puts a little perspective on as a developer ownership of just how hard it is to run a ground floor
Yeah.
retail
Yeah.
space. I mean, I can't tell you how many times through my career where you see rents just ratchet up on small business in particularly in the retail space, and just how hard it is to make everything work. It's tough.
I
So
think, yeah, for me, dude, like just how I've viewed this. I just remember texting with you back in the day when you, Jason, were considering doing this. And I think the thing that stuck with me then that I sort of see now is just that place for exchange. And I just look at this from a real estate perspective. This is all about commercial real estate. That purchase created a moment for people to rally around at a time in the city that was tough, and just network, talk about deals, share pressures, potential successes, and just keep the conversation about like how to make it better because it should be, and how people in the commercial real estate sphere just had a place to kind of go back to, like resuscitated from before COVID. And I think for me, just that place of social exchange, that place of connectivity among just the protagonists in the CRE space. I mean, the success of downtown, the rebirth of downtown owes a lot to that. Just beyond like its capacity to recover independently, it takes action. People walking the walk, not just talking the talk about how to make things better. I think at the end of the day, Chris, like when you look back on this, that's going to be a really important moment in how the CRE equation in downtown San Francisco pivoted around, just because you created a place for people to want to be together and talk about how to fix it. So, but I've also been there and drank a Guinness, so that's one too.
Wonderful. Well, Chris, I know we got to let you go. So thank you very much for taking the time to speak with us. Rob, always good to see you. Gentlemen, have a wonderful rest of the week.
Yeah, this is great, fellas.
thanks for having me, guys. Talk soon.
Okay, take care.